Hey folks, Happy New Year. So I just wanted to quickly review what the stock market did in 2022 and also look at some trends that are probably going to play out in the next year. Looking at the S&P 500, it's been a pretty bad year. The index is down about 20%, and it's been kind of a peculiar year because this marks one of the few times in history that there were more down days than up days. Most of the time, even if the stock market is down overall, the bounces are quite strong, so we get more up days and down days, but this is one of those years where it did not play out that way. One of the things I learned about this year is that really bad days in the market can make up most of the losses for the year. For example, most of this minus 20% return, like over 90% of this, can be explained with just 5 really bad trading days. On April 29th, the S&P 500 was down 3.6%, and the same thing happened on May 5th. And just most recently, the biggest fall was September 13th, where the stock market went down 4.3%. And if you add up all of these negative returns in just these 5 days alone, that makes up like 19% of the 19.95% decline. And on all of these 5 days where the stock market dropped really heavily, what they all seem to have in common is that they happen on days where there was news announcements related to either interest rates or inflation data. So for me going forward, really the takeaway is to be very careful if I'm doing like any kind of day trading or swing trading around those times where we have Fed rate announcements or CPI announcements. Now, that doesn't mean you should get out of the market during these days, because if the news turns out to be good, then you could also have a really large rally that day. So maybe something to do in 2023 is to expect volatility during these news announcements, and then either make directional moves with stocks or use option strategies to take advantage of lowering implied volatility shortly after these events. Now, not everything was bad this year because if you are Canadian like myself, you probably have a lot of energy stocks in your portfolio, and that sector did really well. You can see ExxonMobil gained 80%, Chevron 53%. Consumer defensive was surprisingly mixed. I would have expected this to do better. But even though Costco had amazing earnings numbers, they're still down 20% for the year. Target's down 35%, and Walmart pretty much broke even. And of course, if you were in any of the technology stocks or communication services, consumer cyclicals, the financial sector, or pretty much anything related to technology, you were probably down a lot. If we look at a graph of the S&P 500 performance broken down into sectors, we can see pretty much everything has been down this year, except this outlier, which is of course energy. XLE is an energy sector ETF that you can buy. And if you had a lot of oil and gas companies in your portfolio this year, then you probably fared pretty well. Everything else had negative returns. The best sector out of these ones down here are XLU, which is utilities, and XLP, which is the ETF for consumer staples. And then all the way down here, we have XLC, communication services. So you would put companies like Google inside that category, and that fared the worst this year. SPX is the middle, which is basically the S&P 500. So if it wasn't for energy being so high, the stock market would actually be down a lot more, I think. Imagine if XLE, instead of being up here, it was like minus 20%, sort of in the middle of the group here. Well, then the SPX will probably be down to like minus 25 to minus 30%, which would be worse than it is right now. But is this trend likely to continue into 2023? Well, let's talk about that right now. One of the trends that I expect to see in 2023 is a reversal of XLC and XLP, which is consumer staples. I don't know what their absolute performance is going to be, but I'm going to predict that communication services like Netflix, Google, Disney will outperform the consumer staples, relatively speaking. And the reason is because from a fundamental perspective, consumer staples are just too expensive right now on a valuation basis. And a lot of technology and software companies, they're trading at a cheap valuation now, not just relative to where they were in the last few years, but also relative to the consumer staples. So for example, if we compare a technology company like Adobe with a consumer cyclical company like McDonald's, most of the time Adobe is trading at a higher multiple because it's a faster growing company. That's why you're paying more for the extra growth. But what happened this year is that McDonald's basically was unchanged. The stock is down just 1.69%. However, Adobe is down 40%. So normally you would expect Adobe to be trading at a higher multiple, but even with a 40% decline, is the multiple still elevated for Adobe compared to McDonald's, which hasn't really moved much? So let's just take a look at both of them side by side. So we have Adobe on the left and McDonald's on the right. Let's start by looking at their PE ratios. Adobe's at 32, McDonald's at 33. So roughly the same for both of these companies. Both are also large cap stocks, with market caps being in the $100 to $200 billion range. In terms of profitability, both companies are sort of on par with each other. We have Adobe with a profit margin of 27%, and McDonald's has a profit margin of 25%. Return on assets about the same, so both companies are able to manage the assets that they have quite efficiently and able to create returns for investors there. So both companies are dominant in their fields. They have great management, reoccurring revenue, and their profit margins are about the same in the mid-20s. Those are all really good metrics and what you want to see in a growing company. And speaking of growth, if we look at the forward PE of Adobe, it's about 22, whereas the forward PE for McDonald's is 25. So even though they both have the same trailing PE, which is the PE over the last 12 months, both at 33 times, what matters a lot more is how fast the companies are growing. So if I take a look at what the analysts are expecting for these companies, we can see there's a huge difference between the growth estimates. In the short term, Adobe is expected to grow 12% in the next quarter, whereas McDonald's is expected to shrink a little bit by 2.6%. For the 2022 year, Adobe is expected to grow at about 12%, whereas McDonald's is 7%. But of course, the market is future looking, so when we look at that for next year, Adobe is expected to grow at 14%, whereas McDonald's at 5%. So if I were to pay 33 times earnings for a company, I would much rather buy Adobe today than McDonald's, because when you buy stock, you're paying for the future cash flow of that company. And because Adobe is expected to grow at pretty much double the speed of McDonald's, this would make Adobe a cheaper buy today. And looking at the ROIC website for Adobe, this is why for the PEG ratio, it's only 1.63, whereas for McDonald's, it's at 4. So the PEG ratio is basically the PE relative to the growth. So the lower this number, the better. Both are heavily held by institutional investors. Adobe is 85%, McDonald's at 70%. Just from a valuation perspective, Adobe is looking much cheaper now if you have a 3 to 5 year or longer time horizon, because in the next 3 to 6 months, I do expect the stock market to be quite volatile, which brings me to the second trend that I am looking for in 2023, which is higher volatility. Here is a chart of the VIX, or the volatility index, looking at the weekly chart. And for 2022, we've pretty much been in this horizontal channel between about 20 and 30. But even though there was a lot of choppiness this year, it's only been in this fairly organized kind of horizontal range. We haven't seen, like in 2022, that large spike all the way up to 70 or 80. So the most likely scenario now is, because the VIX is down here, it's probably going to chop around down here for a bit and then move all the way back up to in the 30s again. But eventually, sometime in 2023, I think we're going to see the bottom of the stock market. And when that happens, the VIX could have a really short-term spike up to like 40 or 50, and it could be over here, or it could be sometime later in the year. I would expect that to happen, the bottom of the market, sometime in the first quarter, if not second quarter. But if you're thinking about putting in a lump sum, like a large amount of money into the market right now, I would be a little hesitant to do so, because I think there is a risk that the S&P 500 is going to dump pretty hard at some point in 2023. And finally, I'm looking at the long-term unemployment rate. This is the number of unemployed for 27 weeks and over. It usually gradually declines until there's a recession, represented by these gray bars, and this number of unemployed goes up very quickly. So over the last 5 years, this is what the graph looks like. This was the 2020 recession, and I think right now the economy is already in a recession, but next year it'll just get deeper. And over the last couple of months, we've seen a pickup of this unemployed number. So I believe September 2022 was the bottom, and then this is going to go higher into 2023. And of course, when this number goes up, it does so at a very steep angle. So I would expect this to increase to at least 2,000 or 3,000 sometime in 2023, and probably in the first half of the year. And that's going to keep pressure on the Fed to reduce interest rates or at least keep them where they are and not raise them anymore, which is also good for the stock market. So those are the three trends I think will happen in 2023. We're going to see a sector rotation, continued volatility in the stock market, and a dramatic increase in the unemployment rate. So those are just some things that I'm expecting. Maybe I'm wrong, who knows? We can check back at the end of the year. But in any case, good luck with your investments. Thanks for watching, and I look forward to talk more with you in 2023.